Hi guys, so I had a completely different video planned for today, but whilst doing research for another video, I came across something that kind of surprised me and something that I seem to have missed, probably whilst being really busy and then away in Poland, etc. So what I thought I would do is change the video for today and share this with you because you may have missed it too. So the thing that I'm talking about is Royal Mail, specifically the fact that they seem to be performing incredibly well, and there seems to be a consensus amongst analysts and finance bloggers that they are a really good buy. So when you're done watching, I would love for you to comment down below and tell me, are you invested in Royal Mail? Will you be investing in Royal Mail now? And what your general thoughts are about all of this. So Royal Mail has been around for over 500 years, and whilst it used to be a government-owned company, it no longer is. It is a publicly listed company and the government own no shares in it anymore, I believe. So let's jump into the research. So if we look at the share price, it's essentially gone from 175 a year ago to almost £6 now. That's a huge gain, which really caught my eye and got me looking more into what's going on here. The analyst ratings for Royal Mail seem to be a strong buy amongst 5 different analysts in the last 3 months on here, with the average price target representing a 12% potential upside. The sentiment seems to be very positive and bullish at the moment, with a 290% momentum on the share. On tip ranks, Royal Mail has a smart score of 10, which essentially means that it is thought to be on the way to outperforming the S&P 500. Now, if we look at Simply Wall Street, it does seem like even they think that it is currently undervalued by about 39%. Sounds pretty good to me. But the thing that I couldn't understand was why they were performing so well. So I did a little bit more digging and this is what I came across. Firstly, they just recently reported their revenues, and their revenues are up almost 17%, which is brilliant. And in case you missed it as well, they are also re-entering the FTSE 100 as of this month. Both really great signs. But the best article I found on the topic, which sort of pulls everything together, is this one. It's from the Motley Fool and it really sums up everything around Royal Mail at the moment. As you can see, they talk about the numbers being very impressive and not really having missed the boat yet. Revenue has increased by 16.6%, and considering that they expected to deliver this level of sales by 23-24, they have actually met the target ahead of schedule. The adjusted operating profit actually grew 116%, which is just huge. On top of that, net debt fell from 1.1 billion to only 457 million. So this highlights that last year was a transformational one. And obviously this is largely accounted for the fact that everyone's been at home and everyone's been ordering stuff because shops have been closed. As a result, this has really allowed them to get on top of their finances and really grow the business. The other thing to note here is GLS. So this is their international arm. It has been growing phenomenally and it accounts for over 30% of their 2021 revenue and has grown 28% from the previous year. Royal Mail are actually expecting this division to generate a huge operating profit of 500 million in 24-25 and 1 billion cumulative free cash flow over the next 5 years. Overall, despite some of the risks of what's going to happen once everything goes back to normal, the Motley Fool thinks that Royal Mail's shares are a buy today. Now, obviously, disclaimer, this was in May, but still, I'm pretty impressed. So I'm probably going to add some Royal Mail shares to my portfolio because it can't hurt. And I did say in my investment strategy changes video that I was going to potentially take more risks and not just stick with the companies that I was going to invest in. So it does seem like something I should probably go for personally. It seems like JP Morgan are also encouraging investors to buy Royal Mail, as it is struggling to understand why the share price has not reacted more positively to its full year results. The final thing to note here as well is that they actually announced a special dividend as a result of the awesome profits that they've had. They announced in March this year that they will pay a special dividend of 10p a share to hand out the surging profits made during the global pandemic. So they're going to pay this out on September the 6th. Now, if we look at Simply Wall Street, it looks like the ex-div date for this is July the 29th. So potentially, if you're going to get in, probably a good time to get in before the ex-div so you can get some of that special dividend.
Okay, so let's have a quick look at the summary. So we can see here that on the valuation it's pretty good, 5 out of 6 checks. Future growth is pretty bad, so we'll have a look at that. Past performance, 5 out of 6 as well. Financial health, 5 out of 6. And then dividend, 3 out of 6. But they're not really a dividend stock. They just sometimes pay dividends. So like I said, 39% undervalued according to them. You can see at the top what they're saying, trading below fair value by less than 20%. Good value based on its PE ratio compared to European logistics industry. Good value based on its PE ratio compared to UK markets. Forecast to decline for earnings, which is interesting. And then good value compared to the XE logistics. If we go on to future growth, just to look at that future growth thing, we can see here that it basically fails every single one of these, which I found really interesting. So I tried to dig more into it, and what it looks like is that what they do here is they only base this off of some sort of linear statistical graph analysis. So, from all the other research we've looked at, it does seem like most people think it's going to grow. So, take that as you will, do more research, of course, but I just found it a little bit bizarre that pretty much everything seems to be pointing towards them increasing. And you can see that the revenue increases, it's just the earnings that seem to be forecasting to decrease, which is a bit strange. So if we look at their financial health, we can see here that it's looking pretty good. Their assets outstrip their liabilities on both the short term and the long term, which is really good. And you can see here their debt to equity history. Obviously, it did go up in 2020, but it has reduced significantly. The other good thing here is that their debt is actually really well covered by their operating cash flow, which is really important because this is one of the reasons companies go bust as well. So we've already had a look at the dividend. It's not very high. It's only 1.69 with the ex-div coming up next month. But if we look at how it compares to the market, it is higher than the bottom 25% of dividend payers in the UK. But obviously it's quite low compared to the top dividend payers in the UK. So the last thing to have a quick look at is the insider trading volume. So there's not much data here, but we can see that the only one they've got is a 6,500 share purchase by one individual, which I guess isn't the worst thing because what we don't want to see is those sales.
That's it for today. Let me know what you think and whether you're going to be buying them or not, and I will see you on Wednesday. Bye.